Hey, good morning, options traders. Well, I talk about fair value an awful lot because it's really the essence of options trading. We have to have a benchmark for value. We need to know where the fair value of an option is, and then we can compare it to the implied volatility to see if it is a good deal. But no matter how many times I talk about fair value, too many times traders go, I just don't quite understand what it's telling us. So let's see if we can make it simple by looking at fair value visualized. So recall that fair value is a very specific concept. It's a mathematical concept, and it is the price that doesn't favor the buyer or the seller. So that's not just true for options, it's true for futures contracts, really for anything. Even casino games, there is a fair value. Of course, the casinos always price them above fair value, meaning that you have to spend more than fair value to play, which is why you're going to have a long run edge against you at a casino. But the concept is exactly the same. So what this means is that if you are trading at fair value, then the trader is expected to just break even over the long run. That's important, not on this trade or even the next 20 or 30 trades. We're talking about hundreds and hundreds or thousands of trades, not counting commissions. You would be expected to just break even. So again, that's whether you're buying at fair value or selling at fair value. And that should intuitively make sense because I know we often hear that, oh, the sellers have an advantage. You always want to sell options. Well, that just simply can't be true, because if it were true, nobody would buy them. There has to be some type of a reason for a trader to buy an option or to sell an option. So this is where the concept of fair value is coming from. But to visualize it, we have to step back and take a look at our bell curve. So let's say that we have a stock at 100 and volatility is 20%. So for those of you who have had statistics, volatility is very simply the standard deviation. So if you've ever had stats classes and you had to calculate a standard deviation, that's exactly what we're doing here. So the volatility number is telling us how wide that bell curve is. So it's actually pretty simple. For a 1-year option, we would say the stock price of 100 times 20% volatility is $20. And so $20 is one standard deviation in terms of dollars. So we know that about 68% of the data will fall within one standard deviation. So that tells us if we had thousands of stocks, all trading for $100, all with 20% volatility, that at the end of the year, about 68% of those stocks would have a price somewhere between 80 and 120. Those same stocks, that same group of stocks, would fall within two standard deviations about 95% of the time. So if we know that one standard deviation is $20, two standard deviations must be $40. So we take our $100 price, we add 40 to it, and we subtract 40 from it. So again, this tells us that 95% of those stocks would have a price in 1 year somewhere between 60 and 140. And then finally, 3 standard deviations, which is just about pushing the outer edges of a bell curve. So 3 standard deviations would be $60. So we know that about 99.7% of the data will fall within 3 standard deviations. So if we take $60 plus 100, upper end that we would expect would be somewhere around 160, and the lower would be $100 minus 60 or $40. So almost all of those stocks, remember that started out at 100 with 20% volatility, almost all of them would have a price at the end of the year somewhere between 40 and 160. Now, it's also very important to understand two caveats. This is not saying that they all must be within this range. This is saying 99.7%. So is it possible we could see a stock price of 170 or 180? Sure. It's just not very likely. Now, the second caveat is that this is always assuming that we are talking about just the effect of volatility. So don't think that, well, if somebody comes out and buys this stock out for $250 and we say, oh, that couldn't possibly be true because it's far more than 3 standard deviations. That's not what the model is saying. It's saying that we're just talking about the effect of drift from volatility, and that's it. So to see this, these ranges under our bell curve, if the center of the bell curve is right here at 100, this blue area is 1 standard deviation. That represents 68% of the area under this curve. And so based on the previous slide, we know that about 68% would fall somewhere between 80 and 120 at the end of the year. We also know that 2 standard deviations is this area under the blue plus the gray. It's all of this right in here. And so we found that 2 standard deviations would count 60 to 140 prices. So that's pretty wide range, and we know that about 95% of all of those stock prices would fall in this range at the end of the year. And then finally, 3 standard deviations is the entire width of this bell curve. It's the red plus the gray plus the blue. And so we know that almost all of these stocks would have a price at the end of the year somewhere between 40 and 160. So once you understand that, the concept of fair value can become a little bit more visual. Fair value is actually the average intrinsic value of all of these options. And so all we have to do is to take all of the possible stock prices under the bell curve, calculate the intrinsic value, keeping in mind that the intrinsic value could be 0 if it's at the money or out of the money. And if it's in the money, we're just going to look at the difference between the stock price and the exercise price. And then all we're going to do is to take the average of all of the intrinsic values. And when you do that, you've got the fair value of an option. So first, let's go over to an Excel spreadsheet, look at it visually, get a better understanding of what it means when we're talking about the fair value of an option, and then we'll go check it against a pricing model. All right, so now we're into an Excel spreadsheet that I put together, and what we're looking at are hypothetical stock prices. I've just programmed Excel to come up with an average of 100, but with 20% volatility. So think of this as maybe lots of times of rolling dice or drawing cards. These are all possible stock prices at the end of the year. So on this first try, we got a stock price at the end of the year, $123.50. And if that's true, there would be $23.50 of intrinsic value for the $100 call, for the at the money. The next try, we got a stock price of $118.40. For the $100 call, it would have intrinsic value of $18.40. The next try, we got a stock price of $90.37. There's no intrinsic value. And we just keep doing this. Now there's 6,000 rows in this spreadsheet. And so if we just were to go through and take the average, just a straight up average of all of these, we get this number right here in red. And if you take a look in this formula bar, it is simply the average of those rows. So it's telling us that this option's fair value should be somewhere around $8. Now, if I hit F9, you can see that we get a different bell curve. We still find that we're getting an average right around 100. Take a look at the upper range here, about 160, like we saw. Look at the lower range, down around 40, like we saw. Now it's telling us that the fair value is about $7.90, at least over those 6,000 tries. Let's try it again. There's another one. Came up with a fair value of about $7.94. So take a look over here, about 160, actually almost 171 or so, 175 almost on this upper tail. Down here around 38, but again, somewhere close to 40 to 160. And it's telling us that the average intrinsic value would be $7.94. So let's try one more. Another 6,000 tries, we got an average of about $7.95. And if we look down here, 37 to 40 on this left tail, and up around 165 to almost 170. But again, somewhere around 40 to 160. And that will always be true. So let's just run through a few of them. Watch this. No matter how many times we try it, that bell curve is changing, not by a lot, always keeping about the same average, always keeping 40 at the low end and about 160 on the high end. But take a look at these prices. Coming up with prices usually in the high sevens, maybe around $8. This time we happen to fall on $7.91. So that's telling us that it looks like the fair value of this option is somewhere around $8 or in the high sevens. So now let's jump over to the OIC's website and take a look at a pricing model and see if we got the right answer. So now we're into the OIC's website, that's the Options Industry Council, And they've got a nice pricing model. So let's do a $100 stock price. This is the average. That's what the model is asking for here. We're going to use the $100 strike at the money. Let's use 360 days to expiration, volatility of 20%. I'm going to leave interest rates at 0, dividends at 0. And if we hit calculate, if we did this right, we should get an option somewhere in the high 7s, maybe close to $8. Hit calculate, and right there, look at that, $7.91. In fact, I think that was the exact number that we got on that last trial right there. But hopefully this helps you to see what it is that you are looking at when we talk about the options fair value. This is one way of understanding it. If we were to just run hypotheticals for thousands and thousands of tries, and we calculate the intrinsic value, whether it's 0 or some positive number, and we just take a straight up average, that's what this is telling you. So now, another way to understand this is that if you were to buy this option thousands of times, no commissions, for $7.91, and these conditions were true, you would be expected to just break even over the long run. If you sold this option thousands of times for $7.91, you would be expected to just break even. And so this is why you have to be really careful as an options trader to look at the historic volatility of the stock and say, here's what the option should be priced at, and let's compare to how it is priced in the open market, which is what we call the implied volatility. And only when you can make accurate assessments between the historic volatility and the implied volatility will you start having success with options trading. Because if you are always buying and selling at fair value and you're paying commissions on top of it, that is a long run losing deal. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.